Shares must be held by an investor for at least 3 years if the income tax relief is not to be withdrawn. So the minimum investment in these shares is 3 years if you want to keep the tax reducer. So if you buy the shares today, you have to keep the shares for 3 years in order to get the income tax reducer. If you sell within the 3 years, then you won't get the income tax reducer even if you buy the shares in any of these companies. Right? So what is it? If we sell the shares within 3 years, what happens? If the shares are sold within 3 years of investment, then the tax relief will be withdrawn as follows. It says if the disposal is not a bargain at arm's length, then full amount of relief originally obtained is withdrawn. So say for example, if you sell the shares to a relative, wife, your son or someone close into your family, then obviously you're not you're not going to give them at the market price. You are going to give them at less than market price. So if in the question it says that you have sold the shares to some of your relative, then it means that you are selling at less than market price. Unless it says that you are selling at market price, then that's fine. So if you're selling the shares within 3 years and you are selling less than market price, then all the relief originally obtained will be withdrawn. So you will have to pay to HMRC whatever tax you have reduced earlier, all right, on the sales date. However, in B it says if the disposal is a bargain at arm's length, there is a withdrawal of tax relief calculated as follows. So if you're selling at market price, then the relief withdrawn will be calculated 30% of market value, whatever you sold at. All right. So for example, the original relief was whatever it was, but if you have sold the shares within 3 years but at market price, then the relief withdrawn will be 30% of market price, 30% of sales proceeds. That's what it says in the notes. Sale proceeds multiplied by 30%. It's a safe proceed. It's not safe. Please make sure you rectify the mistake. It's sale proceeds multiplied by 30%. All right. After that, it says CGT reliefs. We will leave it for a minute. We will discuss it later. We are just looking at the income tax relief for now. These are the reliefs which I just told you on the board. These are income tax reliefs. These are not CGT reliefs. So we will leave it for a minute. It says the next one is the Seed Enterprise Investment Scheme. It's the Seed Enterprise Investment Scheme. SEIS is a scheme also designed to promote high-risk unlisted trading companies and raise finance by issue of ordinary shares to individual investors. SEIS investments are high-risk companies. As I said, these are very high-risk companies. SEIS high-risk than EIS. Why? Because these are unlisted and these have got 25 employees or less than that, and gross assets of £200,000 or less than that. All right. SEIS investments are high risk because investments are made in small sized unquoted companies which have less than 25 employees and gross assets of £200,000. So the gross assets are £200,000 or less than that, and these have got 25 employees or less than that. That's why these are very high risk and these are very small companies. All right. Now, what is the benefit of putting the money in this scheme? It says income tax relief, tax reducer. Individuals can claim a tax reducer of 50% of the amount subscribed for qualifying investment. So whatever you invest in this company, 50% of that will be tax reducer. All right, as I said on the board. Remember, tax reducer can only reduce the tax liability to zero. Can only reduce the tax liability, but cannot change the liability into negative. So maximum the tax reducer can do is to change the tax liability to zero. It cannot go into negative, just like the EIS. All right. It will again say in the VCT as well. The maximum qualifying investment in SEIS is £100,000. All right. So maximum you can invest in SEIS is £100,000. What was the maximum you could invest in EIS? You remember? It was £1 million. Yeah. But here you can invest, maximum you can invest is £100,000. All right. For crunch year. However, if you want to invest more than that, the shares will be assumed to be issued in the previous tax year, and the relief will also be given in the previous tax year as well. All right. Then it says the CGT relief. We will leave the CGT relief. And after that it says withdrawal of income tax and capital gains tax relief. Shares must be held for at least 3 years, just like the EIS. We have to keep the shares for 3 years if the income tax relief is not to be withdrawn. If the shares are sold within 3 years, then if it is at market value, then if it is not at market value, not a bargain at arm's length. Bargain at arm's length means that selling at market price. So if it is not a market price, then all the relief originally obtained will be withdrawn. If it is at market, it is at market value, then the withdrawal of relief will be calculated as the sales price multiplied by 50%. So whatever the sales price is, we'll have to take the 50% of it, and that is the amount by which the relief will be withdrawn, right? Next one is the VCT. On the next page, VCT is a company listed on the London Stock Exchange that invests in small unquoted EIS type companies. To be HMRC approved, a VCT must satisfy certain conditions. The investments in VCT is moderately high risk investment. So it is not much high risk because it is a listed company, and we all know that when we invest in a listed company, it is a little bit of safe investment, right? Then it says that income tax relief, tax reducer, individuals can claim a tax reducer of 30%. If you invest something in this VCT company, then 30% of that will be tax reducer, right? Remember that tax reducer can only reduce the tax liability to 0, but it cannot change it into negative. The maximum qualifying investment in VCT is £200,000, excuse me, for current year, on which the tax reducer can be claimed. So it is £200,000 maximum you can invest in this scheme. Alright. Now withdrawal of the tax reducer relief, shares must be held for 5 years at least. If you remember from EIS and SEIS, the maximum you could invest was 3 years, whereas in VCT you will have to wait for 5 years if you want to keep the relief, alright, because it is a listed company and you will have to wait for quite longer than what you would have in the EIS or SEIS. Alright. If the shares are sold within 5 years, then again same like EIS and SEIS, that if you sold the shares within 5 years, then the tax relief will be withdrawn. If it is not a market price, then all the relief originally obtained will be withdrawn. If it is a market price, then sale proceeds multiplied with 30%. If you are selling at the market price, then you'll have to take 30% of the market price. That is the amount by which you that is the amount which you will have to pay back to HMRC, because you have not paid tax on that earlier because you have sold the shares within 5 years. All right. Then after that it says dividends received from VCT are exempt. So, but you don't have to fulfill the minimum holding requirement. You can sell the shares tomorrow, but the dividend still will be exempt. Alright, so there is no such condition for this to apply. CGT relief, we will leave it for a minute because, as I said, we will see it later. Alright, so that's it. That's it. Our lecture for this one, EIS, SEIS, and VCT. Before I wind up this lecture, I would like to move to exam kit, please. Practice and revision kit. I hope that you have already bought your exam kits. If you haven't bought it, please make sure you buy one from approved learning provider. I will take you through the exam kit of BPP. If you want to buy, please make sure you buy one from BPP. If you prefer any other, I don't mind, that's fine. It's just that I will be taking you with the BPP exam kit, alright? I will share the question with you. We will do a little bit of exam study question. Here you go, that's question number 1 of the BPP exam kit. Styrex it says, and it's worth 53 marks, so it will take you 53 marks to solve this question, but don't worry, we will do a little bit of part of it. Now if you go middle way to the question where it says Styrex brother taxes, so if you read from here, I'm reading it with you, it says Styrex, not Styrex, it's Styrex brother taxes. Taxes is single, he says, not married or in relationship, prepared to take medium to high risk in investments, so he is prepared to take some risk. Considering investing in EIS, SEIS or in VCT, and he has not previously made any investments under any of these schemes. So he's considering investing in some of these schemes in order to get some relief. all right, either in order to get some relief or could be some other reason. But what we need to do is, if you come at the bottom of the question, at end of the question, it says part B, write a memorandum to taxers setting out the income tax consequences. Please make sure you underline this. If you have the exam kit in the hard copy, please make sure you underline income tax consequences. He's just asking for the income tax consequences. He's not asking for CGT consequences. As I said, as far as these three schemes are concerned, there are two types of consequences. One is income tax reducer, other is CGT reducer as well, all right, which we haven't studied yet. And we are lucky that in this question he's asking just for income tax consequences. That's what we have just learned, all right. So income tax consequences of investing in EIS, SEIS and VCT, you should include detail of risk and tax implications of each type of investment, all right. So it's exactly what you have learned here. It's exactly what you can see on your notes. You just need to copy and paste from your notes into the exam paper, into this question. But you will have to consider the individual's name. You'll have to write down that, you know, taxes want to do that, taxes should do that, taxes can do that. So you will have to use his name into the questions. It will look more professional and more relevant to the question. So examiner will know, in case if it is examining the question, examiner will know that you are considering the requirement of the question. You know what he is asking in the question. You know the who are you addressing. That's the answer will look professional, right? And after doing this question, I assume after you finish this lecture, please make sure you have a go at this. And after doing that, if you have the exam kit with you, please make sure you go back to the answers and check whatever you wrote on your notebooks. Please make sure you check it with what it says in the exam kit, and try to compare it, that how many marks have you got, or how far have you gone after comparing it with your answer, all right? Likewise, if you whatever questions we do in our lectures, please make sure you check the answers at the back of the exam kit. If you feel any problem, or if you can't compare it, or if you have any type of inquiries, you can always email us on admin@accountancytube.com. All right? That's it for now, I think, and I will see you in the next lecture with more bits and pieces of UK taxation. All right? Till then, goodbye and take care.